Hi folks, welcome back to our third and final video on the Grant and Lee problem. In the very last part of the problem, I asked you to assume that instead of Grant using the cost method to account for its investment in Lee, it decided to use the equity method to record and report its investment in Lee. In this case, using the equity method, what would be the value of the investment in Lee account at December 31st, year 6, and that would be on Grant's separate entity statements. So now, let's begin our discussion of that concept. Now, you'll remember that under the cost method, the investment would stay on Grant's books at the original purchase price paid, which is $70,000. We can actually see that in the question if we go back up here. On Grant's separate entity balance sheet, the investment in Lee is staying at cost. That's what they paid back on January 1, year 4 when they bought it. We're asking you to think about what would it be at December 31st, year 6 under the equity method. Again, under the cost method, whatever they paid on January 1, year 4, that is the value of the investment in Lee on Grant's books at the end of year 6 as well. It doesn't change. But under the equity method, what we have seen in previous chapters, we know that the value of the investment account, when accounted for in the equity method, will be different. How much different? Well, in our course, we've shown you two ways that you can calculate the investment in that subsidiary company, in our case Lee, at this December 31st date. The first way you can do it, and to me it's the easiest way, but it has to make sense to you and you have to feel comfortable with it, is to start with your NCI value. You calculated that earlier on in this question, right? You can use this value that you found for NCI at the end of year 6, $20,800. Why? Well, don't forget that $20,800 represents the non-controlling interest shareholders' share of the fair value of the investment in Lee, because NCI shareholders are shareholders in the subsidiary company, not the parent company, Grant, but the subsidiary company, Lee. So therefore, whatever the 100% of that fair value of the investment is, NCI is holding 20% of it. So what you can do is you can take the NCI value and divide it by 20%. That would give you the full 100% of the investment, right? So in other words, if I did this, 20,800, and I divided that by 0.20, that would give me 100% of the investment in Lee at its fair value, right? That's what that number gives me. But because Grant only owns 80%, whatever I get when I take 20,800, which is NCI, and divide it by the NCI's 20% share, that's going to give me the full amount of the investment in Lee. I only want, as Grant, I want to show on my equity-based balance sheet, separate entity, I want to show my 80% share. So that's why we go ahead and multiply it by 80%. Doing that would tell me that the investment in Lee account on Grant's separate entity balance sheet at December 31st, year 6 is going to be $83,200. All right? That's one way you can do it. The other way you can do it is you can look at the opening value of the investment. That was the amount that Grant paid for the investment in Lee at the date they bought it, January 1, year 4. That was $70,000. But since that time, Lee has earned equity. We can see that there's been a change in its shareholders' equity from the date we became related in year 4 to the end of year 6. That change in equity is due to the fact that it's been earning more income from year 4 all the way to year 6. So what we might do is we might say, well, wait a minute now. NCI is going to get, Grant is going to get its share of the post-acquisition adjusted retained earnings of Lee, the sub. That's going to represent the increase in equity that belongs to Grant. And we already did this when we calculated our ending balance of consolidated retained earnings at the end of year 6. If you go back to part F, we did that. We did that here. We said the post-acquisition adjusted retained earnings of Lee is $16,500 at the end of year 6. That represents, again, the $65,000 in separate entity retained earnings of Lee, less its acquisition retained earnings. So again, we're only looking post-acquisition. So post-acquisition, there's only $35,000 of earnings that Lee has earned while it's been related to Grant. But don't forget, the income of Lee has also been amortizing those acquisition differentials and taking in the impairment losses. So that is our post-acquisition retained earnings of Lee, of which Grant gets 80% because they own 80%. So that represents the increase in the investment account in Lee from the date the two entities became related to the current date, which is the end of year 6, because this is the number we're calculating at the end of year 6, right? So all we have to do is add that to the 70,000 and we'll get the same value, 83,200. So now I always like to show you where possible, if there are two different ways to calculate numbers, I'd like to show you those because sometimes some students feel more comfortable with one way than the other. And in some cases, students always like to go in and check their work. So a student might say, well, I'm going to do it both ways just to make sure I get the same answer, because if I do, I'm more confident that I got it. So that's what happens. Now again, if you think about it, if you go back to the question, right, you'll see on the balance sheet at the end of year 6 when we had the cost method, because it said Grant used the cost method, see the investment in Lee is $70,000. That's the cost. But if we were using the equity method, the investment account would not be sitting at $70,000 on Grant's separate entity balance sheet. It would be sitting at $83,200. So this concludes our third and final video on this problem, Grant and Lee, whereby we calculate the value of the investment account in Lee if Grant used the equity method to record and report its investment in Lee. I hope you found this video helpful.